Here's a mind-blowing fact: 78% of new investors think index funds and ETFs are the same thing, and this confusion is costing them thousands. I'm about to show you why this matters way more than you think, and how understanding this difference could save you serious money. Welcome back to Cashflow Kingdom, where we break down personal finance for real people. I'm here to help you build wealth without the Wall Street jargon. Today, we're settling the index fund versus ETF debate once and for all. By the end of this video, you'll know exactly which one fits your situation, when to use each, and most importantly, how to avoid the costly mistakes that trip up most beginners. Let's start with the basics because this is where most people get confused. Think of both index funds and ETFs as baskets. Instead of buying individual stocks like Apple or Microsoft one by one, you're buying a whole basket that contains hundreds or thousands of stocks. An index fund is like a basket that you can only buy or sell at the end of each trading day, and you buy it directly from the company that manages it. An ETF, or exchange-traded fund, is like that same basket, but you can buy or sell it anytime during market hours, just like a regular stock. Here's the key point most people miss: both can track the exact same index. You could have a Vanguard S&P 500 index fund and a Vanguard S&P 500 ETF that hold identical stocks in identical proportions. The difference isn't what they own, it's how you buy and sell them. This is where things get interesting. With an index fund, if you decide to sell at 2 p.m. on a Tuesday, your order won't execute until the market closes at 4 p.m., and you'll get whatever the price is at that moment. With an ETF, you can sell at 2 p.m. and get the exact price at 2 p.m. Sounds like ETFs are better, right? Not so fast. Here's what the financial gurus don't tell you: this flexibility can actually hurt beginner investors. When you can trade anytime, you're more likely to make emotional decisions. You see your ETF drop 5% at lunch, panic, and sell. With an index fund, by the time the market closes, you might have calmed down and realized it was just a normal market fluctuation. The disadvantage of index funds actually protects you from yourself. Remember, successful investing isn't about perfect timing, it's about time in the market. Here's where it gets expensive if you don't pay attention. Many brokerages charge you a commission every time you buy or sell an ETF, just like a stock. That might be $7, $10, or more per transaction. If you're investing $500 monthly, that's $84 per year just in transaction fees. Index funds, especially from the same company where you have your account, often have zero transaction fees. But wait, there's more. ETFs have something called bid-ask spreads. This is the difference between what buyers are willing to pay and what sellers want. For popular ETFs, this might only be a penny or two, but for less popular ones, it could be significantly more. Index funds don't have this issue because you're buying directly from the fund company at the exact net asset value. Over time, these small costs add up to real money. A $10,000 investment losing just 0.5% annually to hidden costs becomes $9,500 after 10 years instead of $10,000. This is a big one for beginners. Most index funds have minimum investment requirements, typically $1,000 to $3,000 for your first purchase. That can feel like a huge barrier when you're just starting out. ETFs, on the other hand, let you buy just one share. If an ETF costs $100 per share, you can start with $100. This makes ETFs incredibly accessible for new investors or anyone who wants to start small. However, here's a pro tip: many brokerages now offer fractional shares for ETFs, meaning you can invest $50 and own half a share. But some index funds have gotten creative too. Fidelity has several index funds with zero minimums, and Vanguard has lowered many of theirs to $1,000. The landscape is changing rapidly, so always check current requirements. The key is to start investing with whatever amount you have, rather than waiting until you can meet a higher minimum. Time in the market beats timing the market every single time. This is where index funds really shine, and it's probably the most important factor for long-term wealth building. Most index funds allow you to set up automatic investments. You can have $300 automatically invested every month without thinking about it. This creates perfect dollar-cost averaging, where you buy more shares when prices are low and fewer when prices are high, smoothing out market volatility over time. With ETFs, automatic investing is trickier because you can only buy whole shares, and prices fluctuate throughout the day. Some brokerages are solving this with fractional shares and automatic ETF investing, but it's not as seamless yet. The beauty of automatic investing can't be overstated. It removes emotion, ensures consistency, and builds wealth while you sleep. If you're the type of person who might forget to invest or talk yourself out of it during market downturns, this feature alone makes index funds incredibly valuable. Consistency beats perfection in investing, and index funds make consistency effortless. Here's something most beginners don't know: ETFs are generally more tax efficient than index funds, and it's not even close. This happens because of something called in-kind redemptions. Basically, ETFs can get rid of their worst performing stocks without creating taxable events for you. Index funds can't do this as easily, so they sometimes have to distribute capital gains to shareholders, meaning you pay taxes even if you never sold anything. For investments in taxable accounts, this can make a real difference over time. However, and this is important, if you're investing in tax-advantaged accounts like a 401k or IRA, this advantage disappears because you're not paying taxes on gains anyway. The tax efficiency of ETFs really matters in regular brokerage accounts. But remember, tax efficiency should never be your only consideration. A slightly less tax-efficient investment that you'll actually stick with long-term beats a perfectly tax-efficient investment that you'll abandon during the next market crash. Alright, decision time. Choose index funds if you want to set it and forget it. You're planning to invest regularly with automatic transfers, you're investing in tax-advantaged accounts, or you know you might be tempted to trade emotionally. Index funds are perfect for the long-term investor who wants simplicity. Choose ETFs if you're investing in a taxable account, you want maximum flexibility, you're starting with a small amount and can't meet index fund minimums, or you're more experienced and won't be tempted to trade frequently. Here's my honest take: for most beginners, index funds are probably better because they encourage good behavior and remove temptation. But as you become more experienced and disciplined, ETFs can offer some advantages. And remember, this isn't financial advice, I'm not your financial advisor, and your situation might be different. The most important thing is that you start investing consistently in low-cost, diversified funds, whether they're index funds or ETFs. The bottom line? Both index funds and ETFs can build serious wealth over time. The key is picking the one that matches your investing style and sticking with it for decades. Don't let perfect be the enemy of good, start with whichever option gets you investing consistently. Want more investing basics? Check out my video on how to choose your first index fund, and if you found this helpful, make sure to subscribe for new money tips every Tuesday. What questions do you have about index funds versus ETFs? Drop them